Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. This video is for educational and informational purposes only. The goal is to empower you with knowledge, but you should always do your own research and consult with a qualified professional to find the best policy for your specific situation. Your financial decisions are your own, so let's make sure they're informed ones. Let me ask you something. You get that car insurance bill in the mail or that email notification. What's the first thing you feel? Is it a little knot in your stomach? You open it up, you see the price, and it is what it is. Maybe it even went up a little bit since last time. You sigh, you grumble, but you pay it. Because what's the alternative? It's a hassle, you're busy, and who has time for that? If that sounds familiar, then I need you to listen very, very closely. Because that feeling of resignation, that habit of just paying the bill, is costing you an average of $435 every single year. For some of you, it's costing over $1,000. You're paying a secret tax, a penalty for being a loyal customer. It's called the loyalty tax, and it's one of the dirtiest little secrets in the insurance industry. They count on you being too busy or too comfortable to shop around. So year after year, they slowly creep your rates up, a practice they call price optimization. It's a fancy term for charging you the maximum amount they think you're willing to pay without leaving. It has nothing to do with your driving record and everything to do with their profit margin. They are banking on your inertia, and for millions of Americans it's working. They're getting away with it. But what if you could turn the tables? What if, in less time than it takes to watch an episode of your favorite show on Netflix, you could force these companies to compete for your business? What if you could see their best offers lined up side by side and pick the winner? That's the promise of car insurance comparison websites. You've seen the commercials. LendingTree, the Zebra, Insurify. They all promise the same thing. A faster, easier way to save a ton of money. One simple form, dozens of quotes in minutes. It sounds like a no-brainer. A magic bullet for high insurance rates. And in many ways it is. But here's the catch. It's not the whole story. And that's exactly why we're here today. In this presentation, we are going to pull back the curtain on the entire world of online car insurance comparison. We're not just going to talk about LendingTree, we're going to dissect how all of these platforms work. We will cover the incredible, game-changing advantages that can genuinely put hundreds of dollars back into your pocket. But we're also going to expose the dark side, the hidden downsides, the privacy concerns, the sales tactics, and the common traps that cause people to actually overpay, even when using a comparison site. My promise to you is this: by the end of this video, you will be a master of this process. You'll know exactly which sites to use, how to use them, and how to navigate their systems to get the absolute rock-bottom best price on your car insurance, without the headaches and without the hassle. And let's be honest, has there ever been a more important time to do this? The price of gas, groceries, rent, everything is going up. Your budget is being squeezed from every direction. Car insurance is one of the few major, recurring bills where you have a significant amount of control. Finding an extra $40, $60, even $80 a month isn't just a small win. For many families, that's a game changer. That's a tank of gas. That's a week of groceries. That's money that belongs in your pocket, not in the marketing budget of a multi-billion-dollar insurance corporation. So, the first question we have to ask is, how do these sites even work? How can LendingTree and others offer you quotes from Progressive, Allstate, and a dozen other companies all at once for free? What's in it for them? Is it really as simple as they make it sound on TV? Or are you the product being sold? What actually happens to your name, your email, your phone number the second you click that Get My Quotes button? And most importantly, what is the #1 psychological trick these sites use that can lead you to choose a worse deal, thinking you got a great one? We're going to cover all of it. Let's start with the biggest, most undeniable pro of using a comparison site: the sheer unadulterated power of speed and convenience. Let's rewind the clock just 15 or 20 years. What did shopping for car insurance look like? It was a nightmare. It was a multi-day project. First, you'd have to get out the yellow pages, remember those? And find the numbers for local agents. You'd call Agent Bob from State Farm. You'd spend 20 minutes on the phone with him, giving him all your information: your name, address, date of birth, your car's VIN number, your driving history, your social security number, everything. He'd thank you and say he'll run the numbers and get back to you in a day or two. Then, you'd hang up and immediately call Agent Susan from Allstate. And you'd do it all over again. The same questions, the same information for another 20 minutes. Then you'd call Geico's 1-800 number, then Progressive's website. Each one was its own separate, painstaking process. After 3 or 4 of these, you'd be exhausted. You wouldn't even want to continue. You'd just take the best quote out of the few you managed to get and call it a day, never knowing if you left hundreds of dollars on the table with the company you didn't have the energy to call. That whole process was designed to create friction, to make it hard to leave your current insurer. Now contrast that with today. You go to a site like LendingTree. You fill out one form. It's a smart form, so it asks you questions in a logical order. It might take you, 5 to 10 minutes? You enter your car's info, your driver details, your coverage needs. You click one button, and in the background, a technological marvel happens. The platform securely sends your information, your quote request, out to its network of dozens, sometimes over 100, different insurance partners. It's like having a team of 100 super-fast assistants all calling those agents for you simultaneously. And within seconds, not days, the results start pouring in. Quote after quote lined up on your screen. Progressive, $120 a month. Nationwide, $115 a month. A smaller company you've never even heard of like Esurance or ClearCover, $95 a month. You can see the prices, the coverage levels, the deductibles all in one place. The power has completely shifted. You're no longer the one doing the chasing. You've made the insurance companies chase you. You've turned a week-long soul-crushing chore into a 10-minute task you can do from your couch while watching TV. This right here is the core revolution of these platforms. They've taken the single biggest barrier to saving money, the sheer friction and hassle of the process, and they have obliterated it. They've democratized access to the market. Before, only the most patient and diligent people could truly comparison shop. Now anyone can. This single advantage is so powerful that it almost makes using a comparison site a non-negotiable first step for anyone serious about cutting their bills. But if it's that simple, why isn't everyone saving hundreds of dollars a year? If these sites are the magic bullet for high insurance premiums, why do so many people try them once, get frustrated, and never go back? It's because the incredible convenience of comparison shopping comes with a set of hidden complexities, a series of traps that can make the process feel more like a battle than a bargain hunt. And the first, most significant one is the illusion of a complete market. When you go to a site like LendingTree, it feels like you're looking at the entire universe of car insurance options. You see logos you recognize, names you trust, and it's easy to assume that the best price they show you is the best price, period. But that's not true. No single comparison site works with every single insurance company. Think of it like a giant shopping mall. LendingTree is a massive, sprawling mall with dozens of great stores. But it doesn't have every store in the country. That cool independent boutique downtown? Not there. Maybe a huge national chain like Costco or Walmart, which prefers its own standalone locations, isn't in the mall either. The same is true for insurance. Some of the biggest names in the business, the ones that spend billions on TV commercials, often choose not to play in the comparison site sandbox. Companies like Geico and Progressive have built their entire business model on you coming directly to them. They've spent decades and fortunes convincing you to go to geico.com, not a middleman. Why would they then pay a commission to a site like LendingTree to send you there? Many times they won't. Other companies like State Farm rely on a vast network of local captive agents. Their model is built on personal relationships, not anonymous online forms. So they're not on these platforms either. What you're seeing on a comparison site is a curated list of companies that have a business relationship with that site. They are the insurers who have agreed to pay a fee for your information, for the chance to earn your business. This doesn't make them bad options. In fact, many are fantastic, highly rated companies. But it's a filtered view. You might be seeing the best price among the 20 companies in that particular mall, but the absolute lowest price in the entire country might be at a store that isn't even on the map you're looking at. This is the first critical piece of knowledge. You are not shopping the entire market. You are shopping a large but incomplete portion of it. The second trap is far more subtle and causes the most frustration. It's the difference between a quote and a rate. You meticulously enter all your information. Your car, your address, your driving history as you remember it. The site crunches the numbers and presents you with a beautiful low price. Let's say it's $95 a month from a company called Affordable Auto. You're thrilled. That's $40 less than you're paying now. You click the link, get sent over to the Affordable Auto website to finalize the deal, and suddenly the price isn't $95 anymore. It's $132. What happened? Was it a bait and switch? Not exactly. What you got from the comparison site was an estimate, a quote. What you got from the insurance company was a firm, bindable rate. The difference lies in the data. The comparison site's quote is based only on the information you provided. The insurance company's rate is based on that, plus a deep dive into your official records they pay to access. The first thing they do is pull your motor vehicle report, or MVR. This is your official driving history from the state. That speeding ticket from 2 years ago you completely forgot about? They see it. The fender bender where you weren't technically at fault but a claim was still opened? It's on there. Next, they pull something called a CLUE report. CLUE stands for Comprehensive Loss Underwriting Exchange, and it's basically the credit report of the insurance world. It's a shared database that details every auto or home insurance claim you filed for the past 7 years, no matter who your insurer was. If you told the comparison site you had no claims, but your CLUE report shows 2 glass claims and a minor collision, your rate is going up. Then, in most states, they pull a credit-based insurance score. This isn't the same as your FICO score, but it's related. It uses elements of your credit history to predict how likely you are to file a claim. It's a controversial practice, but it's a statistical reality that insurers rely on heavily. A lower score often means a higher premium. Finally, they verify everything else. They use databases to confirm your vehicle's VIN, its safety features, and even use location data to verify that the address where you garage the car is accurate. They know if your zip code has a higher rate of theft or accidents. The comparison site's quote is like a movie trailer. It shows you the exciting highlights based on a simple story. The final rate is the full movie, with all the plot twists and details revealed. This gap between the initial quote and the final rate is the single biggest reason people get disillusioned. Feels deceptive, but once you understand what's happening behind the curtain, that the insurer is simply validating and enriching the data, you can set your expectations correctly. Don't fall in love with the first number you see. Treat it as a promising ballpark figure, a starting point for a conversation, not a contractual promise. But even if you understand the incomplete market and the quote versus rate problem, there's a third trap waiting for you the second you hit that "Get My Quotes" button. It's the data deluge. You need to understand that sites like LendingTree are, at their core, lead generation businesses. You are the product. Your lead, your name, contact information, and expressed interest in buying insurance is valuable. And when you submit your form, you are giving them permission to sell that lead to their network of partners. What this means in practice is that your phone is about to become very, very popular. Within minutes, sometimes seconds, you'll start getting calls and texts, and your email inbox will begin to fill up with automated messages. Each one is from a different agent or company, all racing to be the first to speak with you. For them, speed is everything. The first agent to get you on the phone has a massively higher chance of closing the sale. This creates a relentless, high-pressure environment for you, the consumer. It can feel like you've accidentally stumbled into a digital Shark Tank. This experience alone is enough to make many people throw their hands up and say, "Forget it, I'll just stick with what I have." The sheer volume of communication is overwhelming. It turns a money-saving task into a stressful ordeal of dodging sales calls. But here's a pro tip, a simple strategy to reclaim control. Create a buffer. Before you ever start filling out forms on a comparison site, set up a free separate email address with Google or another provider. This will be your shopping email. All the quotes and follow-ups will go there, not to your personal or work inbox. Next, get a free Google Voice phone number. It's an app on your phone that gives you a second number. Use this number on the forms. All the calls and texts from agents will go to the Google Voice app, not your main phone line. You can check the messages on your own time, without your phone buzzing off the hook during a work meeting. This simple two-step process, a separate email and a separate phone number, acts as a firewall. It allows you to gather all the information and engage on your own terms, transforming the experience from a chaotic inbound assault into an organized outbound research project that you control. So, we have this powerful tool that saves immense time, but it comes with catches. It doesn't show you the whole market, its initial prices can be optimistically inaccurate, and using it can unleash a torrent of unwanted communication. Seems like a paradox, but these aren't reasons to avoid comparison sites. They are simply the rules of the game, and once you know the rules, you can learn how to win. The key is to shift your perspective. Don't view these sites as a one-stop shop to buy insurance. View them as a powerful reconnaissance tool, the first step in a multi-pronged strategy to find the absolute best rate. And that strategy begins by understanding that not all comparison websites are created equal. They fall into different categories, and knowing which type you're on will fundamentally change how you use it to your advantage. They fall into two primary camps, with a sneaky third one we'll get to in a minute. And the first one is the one that gives comparison sites a bad name. This is the lead generator. Think of a lead gen site like this. You're not walking into a store. You're walking into a massive open-air bazaar, stepping onto a wooden crate and shouting, "I have money and I need car insurance." What happens next? You're immediately swarmed by a dozen, 2 dozen, maybe even 50 different merchants, all grabbing at your sleeve, shouting their deals and promising you the world. That, in a digital nutshell, is a lead generator. When you fill out a form on one of these sites, you are not getting a quote. Let me repeat that, because it's the most important thing you'll learn today. You are not getting a quote. You are creating a lead. A lead is your digital ghost, your name, your car, your driving history, your contact information, packaged up into a neat little file. The website then sells that lead to a network of hungry insurance agents and brokers. They might sell it to 5 agents, or they might sell it to 50. And every single one of them who buys your information is going to contact you. This is where the infamous phone call tsunami comes from. Your phone will vibrate off the table. Your email inbox will suddenly look like a clown car, with an impossible number of messages piling in. You'll get texts at dinner. It can feel invasive, overwhelming, and frankly like you made a horrible mistake. You gave them your information expecting a simple list of prices, and instead you got a full-blown telemarketing campaign launched directly at your life. So why would anyone ever use one of these? Well, there are actually a few surprising upsides. First, the reach can be enormous. These lead gen sites often work with hundreds of smaller, local, or regional insurance agents you would never, ever find on your own. You might get a call from a guy 2 towns over who has a special deal with a local credit union that could save you a fortune, something a giant national comparison engine would never know about. Second, you get to talk to a human. If your situation is complex, maybe you have a vintage car, a DUI on your record, or you're trying to bundle 5 different policies, an algorithm can't always handle that nuance. A real live agent can listen to your story, ask the right questions, and manually search for discounts that apply specifically to you. They can be a problem solver in a way a computer program just can't. But the downsides are significant. You have absolutely no control. You can't choose who calls you. You can't pre-screen the companies. You are completely at the mercy of whoever decided to buy your information that day. And remember, the person calling you isn't an impartial advisor. They are a salesperson. Their goal is to sell you their product, not to help you find the absolute cheapest product on the entire market. They want their commission. So while they can be helpful, you have to go into that conversation with your guard up. The easiest way to spot a lead gen site is the language they use. If you see phrases like "connect with local agents," "providers will contact you with a quote," or "get your free quotes from our partners," that's a massive red flag. If the final button says "get my quotes," but there's no list of insurance companies visible on the page, you're about to step on the crate in that bazaar and unleash the swarm. Now let's talk about the second, and generally more user-friendly category, the aggregator. This is what most of us think we're using. An aggregator is like Kayak or Expedia for insurance. They have direct partnerships with a range of insurance companies. When you fill out your information, the aggregator's technology pings the servers of all their partners, like Progressive, Travelers, Nationwide, in real time. It then pulls back actual legitimate price estimates from each one and displays them for you, right there on the screen in a neat, orderly list. This is a game changer. The power is back in your hands. You get instant gratification. Within a minute or two, you have a snapshot of the market. You can see the names, you can see the prices side by side. You are in control. You can browse the results anonymously, without a single person calling you. You decide which company looks promising. You decide if and when you want to click through to their website to finalize the deal. The phone call tsunami is replaced by a calm, quiet sea of information. The efficiency is incredible. In 10 minutes on an aggregator, you can do the work that would have taken you an entire day of calling individual agents or filling out forms on 10 different websites. It's fast, it's clean, and it gives you a powerful starting point for your research. But, and this is a huge but, aggregators are not perfect. Their biggest weakness is an incomplete picture. No single aggregator has every insurance company on its platform. Some of the biggest names in the business, like Geico or State Farm, often choose not to participate. They want you to come directly to their website so they don't have to pay a commission to the aggregator. So, if you only use one aggregator, You could be missing out on a fantastic rate from a company that simply isn't in their system. Furthermore, the price you see is almost always an estimate. It's a very, very good estimate, based on the information you provided. But it's not a final bindable quote. The moment you click select and get transferred to the insurance company's official website, they will almost always ask for a little more information. They'll run your full, official motor vehicle report and a more detailed credit check. If they find a speeding ticket you forgot about, or a claim from 3 years ago that didn't come up in the initial soft check, that price can, and often does, change. It might go up by $10 or it might go up by $50. This is probably the single biggest point of frustration for users. You get excited about a great price only to have it change at the very last step. So you have the lead generators which sell your info to people, and the aggregators which show you prices from programs. The bazaar versus the digital supermarket. But the modern internet is rarely that simple. Which brings us to the third and most common type of website you'll encounter today, the hybrid. This is where a site like LendingTree and many of its competitors live. A hybrid site tries to be the best of both worlds, and in doing so, creates a new layer of complexity you have to navigate. A hybrid site is a chimera. It's part aggregator, part lead generator. On the results page, they might show you 5 or 6 real-time, instant quotes from their direct insurance partners, just like a true aggregator. You'll see the logos, you'll see the estimated monthly premiums. It looks and feels just like Expedia, but right below that list, or maybe in a checkbox you barely notice, there will be an offer. Something like, want even more quotes? Check this box and we'll have our extended network of partners contact you. If you click on those initial, instant quotes, you'll be taken to the insurer's website to finish the application. No phone calls. But if you check that little box, you've just stepped on the crate. You've just given them permission to sell your information as a lead. They do this to maximize their business. They make a little money when you click on one of the instant quotes, but they can often make more money by selling your lead to a network of hungry agents. So they try to do both. They give you the instant gratification of an aggregator to draw you in, and then they dangle the more options carrot of a lead generator to make some extra cash. This isn't necessarily evil. It's just their business model. But it is incredibly confusing for the average person. You think you're on a simple comparison site, but you're actually navigating a minefield of different offers. One click leads to a quiet, controlled experience. Another click, just inches away, unleashes the phone call tsunami. Knowing how to tell the difference between those clicks is the key to using these sites effectively. You have to be able to dissect their results page and understand what is an aggregator link and what is a lead gen trapdoor. Now that you can identify the type of digital beast you're dealing with, the people-focused lead generator, the program-focused aggregator, or the two-headed hybrid, the question becomes, how do you tame it? How do you feed it just enough information to get what you want without getting eaten alive by salespeople? That's where the ghost profile technique comes in, and it's the single most important strategy you need to know before you type a single letter into that form. It's a digital shield, a firewall between you and the ravenous sales machine. The goal of the ghost profile is simple: to get the accurate, comparable quotes you need, while making your personal contact information virtually untouchable. Think of it like this. You're sending a drone into a hostile environment to gather intelligence. The drone is your ghost profile. It looks real, it acts real, it gathers the data, but if it gets shot down, meaning if the information gets sold and spammed, your actual command center, your real life, remains completely safe. You're in control, not them. This isn't about lying. Let me be crystal clear about that. We are not going to lie about our driving record, the car we drive, our age, or anything that is a material fact used to calculate an insurance rate. That is fraud, it's illegal, and it's just plain stupid. It will get your policy canceled, likely when you need it most after an accident. The ghost profile is not about faking your risk. It's about protecting your privacy. We are creating a strategic buffer, a carefully constructed persona that is 99% you, but with a Kevlar vest around its contact details. So how do we build it? It's a 3-step process and you need to do all 3. Step 1 is creating your ghost email. Never ever use your primary personal or work email address on a comparison site. The moment you hit submit, that email address is flagged, sold, and will be on marketing lists for years to come. You'll be getting emails about car insurance, extended warranties, and refinancing your non-existent mortgage until the end of time. The solution is to create a brand new, completely disposable email address. Go to Gmail, Outlook, whatever you prefer, and create a new account just for this mission. Call it something like johnsmithcarquotes2024@gmail.com or shoppingforinsurance@email.com. It doesn't matter. The only purpose of this email is to be an inbox for the quotes and the inevitable follow-up marketing junk. Once you've bought your policy, you can either ignore this email account forever or delete it entirely. It's your digital burn box. Step 2 is the most important part of this entire strategy. The ghost phone number. Giving them your real cell phone number is the single biggest mistake you can make. It's like painting a giant target on your back and handing a megaphone to every insurance agent within a 100-mile radius. It's not just the phone calls. It's the endless automated text messages. It's a nightmare. The solution is to get a free, disposable phone number from Google Voice. If you've never used Google Voice, it's about to become your new best friend. It's a free service from Google that gives you a brand new phone number in any area code you want. You can make and receive calls and texts through the Google Voice app on your smartphone or on your computer. But here's the magic. It acts as a perfect shield. When someone calls your Google Voice number, you can have it forward to your real phone but with a twist. You can turn on call screening so your phone announces who is calling before you decide to answer. A call comes in, your phone rings, and you hear a computer voice say, "Call from Progressive Insurance." You can then press 1 to accept the call, or 2 to send them directly to voicemail. You see the power here? You are the gatekeeper. Your real phone never has to ring. You can let every single call go to voicemail. Google Voice will then transcribe those voicemails into text and email them to your ghost email address. You can read through the messages from agents at your leisure without ever having to speak to a single person. You've just turned a high-pressure, inbound sales attack into a calm, organized intelligence-gathering operation. And the best part? When you're done shopping, you can go into the Google Voice settings and turn on Do Not Disturb. Every future call to that number goes straight to voicemail without ever bothering you again. It's the ultimate off switch. You've effectively vaporized the target. Okay, so we have our ghost email and our ghost phone number. Now for step 3, which is the most nuanced, your personal information. Again, we are not committing fraud. We are being 100% truthful about our driving history, our vehicle's VIN number, our date of birth, our marital status, and our credit range. These are sacred, but there are a couple of small things we can tweak to prevent data brokers from creating a perfect, ironclad profile on you that they can then sell to other industries. First, your name. If your legal name is Michael Anderson, use Mike Anderson or Michael A. on the form. It's a minor variation that is still clearly you, but it's enough to disrupt the automated data matching algorithms that look for exact Michael Anderson matches. Second, and this is the tricky one, is your address. Your address is critical for an accurate quote. Rates can vary block by block, so you must use your real location. But you don't have to make it perfectly clean for the data scrapers. If you live at 123 North Elm Street, apartment 4B, you can enter it as 123N, Elm Street #4B. Or even introduce a common plausible typo like 123 North Elm Street. The insurance quoting engine is smart. It uses a system called geocoding that will almost always recognize the address and correct it internally to give you an accurate rate for your physical location. However, that slightly dirty data you entered is less valuable to a third-party data broker who relies on exact, verified address matches to build their consumer profiles. The quote is accurate, but your data is slightly sandblasted, making it harder to sell. And let me repeat this for the third time because it is critical. When you find the policy you want and you go to the insurance company's official site to buy it, you must use your full, correct, legal name and address. The ghost profile is for shopping, not for purchasing. So let's put it all together. You're sitting at your computer, ready to dive into a comparison site like LendingTree, but you're not nervous. You're prepared. You open a browser window and log into your new ghost email account. You have your Google Voice number ready on a sticky note. You've decided to use Mike A. as your name. You enter the information about your car, your driving history, all of it completely 100% accurate. Then you get to the contact page. You confidently type in your ghost email. You type in your Google Voice number. You type in your slightly modified address. You take a deep breath and you click Get My Quotes. And then, nothing happens to you. Your personal phone doesn't ring. Your primary email inbox is silent. But over in your digital command center, things are starting to happen. The ghost email inbox starts dinging with confirmation messages and initial quotes. The Google Voice app might show a missed call or two. with voicemails neatly transcribed for you to read. You are in complete, total control. You've successfully extracted the immense value of a comparison site, getting dozens of quotes in minutes, without paying the price with your privacy and your sanity. You flipped the script. You're no longer the product being sold. You're the savvy consumer who is now in a position of power, ready to analyze the data you've gathered on your own terms. But now you're looking at a dozen different numbers from companies you've never even heard of. How do you tell a good quote from a trap? How do you compare apples to apples when one policy has a $500 deductible and another has a $2,000 one, with bizarre liability limits you don't understand? That's the science of quote normalization, and it's the key to not getting ripped off by a cheap-looking policy that's actually worthless. We're going to break that down next. It's the single most important step in this entire process, and it's the one almost everyone skips. Quote normalization is simply forcing every single insurance quote you get to cover the exact same things. It's creating a level playing field. You wouldn't compare the price of a Ford F-150 with a V8 engine, leather seats, and a tow package to a base model with a V6 and cloth seats, right? You'd say, of course the base model is cheaper, it's a totally different truck. It's the exact same with insurance. Policy is not just a policy. It's a package of individual coverages, and if those packages aren't identical, their prices are meaningless. So how do we do it? We focus on the 4 pillars of your policy. First and most critically are your liability limits. This is the big one. This is the coverage that protects your entire financial future if you cause an accident. It pays for the other person's medical bills, car repairs, and even legal fees if they sue you. It's usually shown as 3 numbers, like 50/100/50. This is insurance speak for $50,000 for bodily injury per person, $100,000 for bodily injury for the whole accident, and $50,000 for property damage. Now here's the trap. Almost every state has a legal minimum you're required to carry, and these minimums are terrifyingly low. California, for example, only requires you to have $15,000 in property damage liability. $15,000. A fender bender with a brand new Honda Accord can easily exceed that. What happens if you slide on a wet road and tap the bumper of a $60,000 Tesla? Your insurance pays the first $15 grand, and then that Tesla owner's lawyer sends you a bill for the remaining $45,000. They can go after your savings, your paycheck, even your house. State minimum liability is a recipe for financial ruin. So the first step in normalization is to decide on a responsible level of liability coverage that you want. A common recommendation from financial advisors is 100/300/100. That's 100,000 for one person's injuries, 300,000 total for injuries in the accident, and 100,000 for property damage. For many people, even that's not enough. But let's use it as our baseline. You go onto LendingTree, you get 3 quotes. Quote A from Progressive is $90 a month. Quote B from Geico is $115. Quote C from Allstate is $130. The choice seems obvious, right? Go with Progressive. But you stop and you look closer. You see Progressive defaulted you to your state's pathetic minimums. Geico gave you a slightly better 50/100/50. And Allstate, the most expensive, quoted you at the responsible 100/300/100 level. You haven't been comparing prices. You've been comparing 3 completely different products. Your job now is to go into the details of the Progressive quote and the Geico quote and manually change their liability limits to match Allstate's 100/300/100. Then you hit recalculate. This is the moment of truth. The second pillar is uninsured and underinsured motorist coverage, or UM/UIM. If liability coverage protects you when you hit someone else, UM/UIM protects you when someone hits you and they either have no insurance at all, or they have those trash tier state minimum policies that don't even cover the damage to your car, let alone your medical bills. Do you really want to trust that the person who runs a red light and puts you in the hospital was a responsible person who paid for good insurance? Statistics say 1 in 8 drivers on the road has no insurance whatsoever. This coverage is not a luxury. It's a necessity. A good rule of thumb is to set your UM/UIM limits to be the same as your liability limits. If you're protecting other people with 100/300 coverage, you should protect yourself and your family with the same amount. So, you go back to your 3 quotes and ensure the UM/UIM coverage is set to 100/300 on all of them. The third pillar is your deductibles. This is the amount of money you have to pay out of your own pocket before the insurance company pays a dime for repairs to your car. This applies to collision coverage, which is for when you hit something, and comprehensive coverage, which is for things like theft, hail, or a tree falling on your car. The relationship is simple. A higher deductible means a lower monthly premium. A lower deductible means a higher premium. This is where you have to be honest with yourself. A quote with a $2,000 deductible will look way cheaper than one with a $500 deductible. But if you get in an accident next week, can you comfortably write a check for $2,000 without derailing your life? If the answer is no, that cheap premium is a lie. You can't afford it. Decide on a deductible you can genuinely handle, say $500 or $1,000, and then, you guessed it, go back to all three quotes and make sure the collision and comprehensive deductibles are set to that exact same number. Finally, the fourth pillar, the add-ons. This is stuff like rental car reimbursement, roadside assistance, and medical payments coverage. One company might throw in rental coverage for free to make their quote look good, while another leaves it out, making their price seem lower. You have to decide what you want. Do you have a second car you can use if yours is in the shop for 2 weeks? If not, you probably need rental reimbursement. Do you already have a AAA membership? Then you don't need to pay for roadside assistance on your policy. You have to go through these line by line and either add them to every quote or remove them from every quote. Total uniformity. Now let's go back to our example. You started with 3 quotes. Progressive at $90, Geico at $115, and Allstate at $130. You were ready to sign up with Progressive, but then you did the work. You normalized them. You set all 3 policies to have 100/300/100 liability limits. You added matching 100/300 UM/UIM coverage to all of them. You set all the deductibles to a realistic $500. And you made sure they all included rental car reimbursement. You hit recalculate on each one, and the world turns upside down. The Progressive quote, once you added all the real-world coverage you need, shoots up from $90 to $165 a month. The Allstate quote, which already included most of that, barely moves, going from $130 to $138. And the Geico quote, the one that was in the middle, lands at $132 a month. Suddenly, Geico is the cheapest. Allstate is a close second. And Progressive, the company that baited you with a super low price, is now the most expensive by a huge margin. This is the power of quote normalization. You just went from making a terrible financial decision based on a misleading ad to making a brilliant one based on hard data. You've uncovered the true price. You've seen behind the curtain. The initial quotes you get from a comparison site are not the end of the process. They are the very beginning of your investigation. The companies that appear cheapest at first are often the ones hoping you won't do this homework, that you'll just click on the lowest number without understanding you're buying a policy full of holes. But now you know better. You know how to force them to compete on a truly level playing field. But there's another psychological trick these sites use, something that happens after you click that shiny low price button, designed to lock you in before you have a chance to back out. It's a subtle but powerful tactic called commitment and consistency, and understanding how it works is the next step to mastering this game. This principle was first documented by psychologist Robert Cialdini, and it's based on a simple universal human desire, our desperate need to be, and to appear, consistent with what we have already done. Once we make a choice or take a stand, we encounter personal and interpersonal pressures to behave consistently with that commitment. Those pressures will cause us to respond in ways that justify our earlier decision. It's a mental shortcut. It saves us time and energy. Instead of weighing the pros and cons of a new situation, we just ask ourselves, what have I done or said about this before? Then we just do that again. It's why if someone asks you for a small favor, like to watch their bag for a second, you're dramatically more likely to agree to a much larger favor later on. You've already committed to being a helpful person in their eyes. You feel an internal pressure to be consistent with that initial tiny yes. Car insurance comparison sites are masters of this. They don't ask you for a big commitment up front. They don't start with, please fill out this 87-field questionnaire to maybe save some money. No one would do it. Instead, they start with the smallest possible ask, the tiniest yes they can get from you. What is it? Enter your zip code. That's it. It's harmless. It's anonymous. Takes 2 seconds. You type it in and click go. And in that moment, without even realizing it, you've taken the first step. You have made a micro-commitment. You have told the system, and more importantly, you have told yourself, yes, I am starting the process of looking for car insurance on this site. Then comes the next small yes. What's the year, make, and model of your car? Still easy. You know this off the top of your head. You fill it in. You've just climbed another rung on the commitment ladder. Then, are you a homeowner? Click. What's your current insurance provider? Click. How long have you been with them? Click. Each field you fill is another small yes. Each one reinforces your initial decision. You're not just providing data. You're building a psychological foundation for a future decision. You are investing your time and effort. This engages another powerful cognitive bias, the sunk cost fallacy. This is the feeling that you've already put so much in, you can't possibly turn back now, even if a better option presents itself. You've already spent 10 minutes filling out forms. Are you really going to close the tab and start all over somewhere else? The website is betting that you won't. They are counting on your desire to be consistent with the effort you've already expended. Finally, after dozens of these small commitments, you arrive at the results page. And there it is, that shiny low price we talked about. It's highlighted. It has a star next to it. It's the hero of the story. Your brain, which is now swimming in a cocktail of commitment bias and sunk cost thinking, sees that price not just as a number, but as the reward for all your hard work. It's the validation for the 10 minutes you just spent. Clicking that button to view my deal, or finalize my quote, is the biggest yes yet. It is the culmination of all your previous micro-commitments. And when you click it, something fundamental changes in your brain. You are no longer shopping. You are now confirming. You have mentally committed to this specific company and this specific price. Your brain's new job isn't to find the best deal anymore. Its job is to find reasons to justify the choice you just made. This is where the trap is sprung. You land on the insurance company's actual website, and the real underwriting process begins. And suddenly, that beautiful low number starts to creep up. They pull your official driving record, and oops, that fender bender from 2 years ago that you forgot to mention adds $12 a month. They check your insurance score, and it's not quite as high as their best-case scenario estimate, so that's another $8. They inform you that the initial quote didn't include roadside assistance, which you absolutely need, so you add that for another $5. Before you know it, the price is $25, $30, or even $40 a month higher than the number that made you click in the first place. Now, the rational move would be to say, hold on, this isn't the deal I agreed to, and go back to the comparison site to start over with a different company. But almost no one does that. Why? Because of commitment and consistency. You've already come this far. You've filled out forms on 2 websites now. You've mentally awarded yourself the victory of finding a great deal. To go back now would be to admit you were wrong. It would be inconsistent with the 20 yes you've already given. Your brain starts to rationalize. It says, well, it's still a little cheaper than my old policy. Or, it's only $1 a day more, what's the big deal? Or, ugh, I do not have the energy to go through that whole process again. This is fine. It's good enough. You accept the higher price not because it's the best deal, but because you are psychologically cornered. The system is designed to make you feel like turning back is a bigger hassle than paying more. So how do you defeat this? How do you break the spell? It's surprisingly simple. You introduce a cooling off period. When you get to that comparison results page, do not click on the most appealing offer right away. Instead, take a screenshot of the entire page. Then close the browser tab. Get up and walk away from your computer. Go make a sandwich, walk the dog, do something else for at least an hour. This short circuit is crucial. It breaks the chain of commitment. It allows the power of the sunk cost fallacy to fade. When you come back later and look at that screenshot, you're no longer in the heat of the moment. You're not under the influence of that "I've already come this far" momentum. You can look at the options with fresh, objective eyes. You can see the page for what it is. A list of estimates, not a set of promises. You can then calmly choose the top 2 or 3 contenders and investigate them individually, fully aware that the price is likely to change, and without the psychological pressure of having already committed to one of them. You've taken back control. You've stopped playing their game and started playing your own. But breaking the consistency trap is only half the battle. Once you do click through to the insurer's website, they deploy a whole new arsenal of psychological triggers designed to convince you that their higher price is not only fair, but that you'd be a fool not to take it. They use a tactic that preys on our fundamental need to follow the herd. It's called social proof. It's one of the most powerful and primitive drivers of human behavior. We are social creatures hardwired for survival, and for millennia survival meant sticking with the tribe. If everyone else was running from a rustling in the bushes, you didn't stop to analyze the sound. You ran too. If the rest of the group was eating a certain berry, you assumed it was safe. Following the herd isn't a sign of weakness. It's a deeply ingrained survival instinct. And marketers know this. They know that when faced with uncertainty, like choosing the right insurance policy from a list of confusing options, we look for a shortcut. We look for what everyone else is doing. So when you land on that insurer's website fresh from LendingTree, you're immediately bombarded with it. You'll see things like, join 25 million satisfied customers. Right away, your brain doesn't register that as a marketing slogan. It registers it as a safety signal. 25 million people can't be wrong, can they? They've already vetted this company for me. The tribe has chosen this path. Feels safer. Then you'll see star ratings, prominently displayed right next to the Get a Quote button. 4.8 stars based on 150,000 reviews. Again, your analytical brain might know that reviews can be curated, filtered, or even incentivized. But your instinctive brain, the one that makes 95% of your decisions, just sees a big shiny number and thinks, wow, people love this company. This must be the right choice. They'll feature glowing testimonials on the sidebar. A picture of a smiling family, the Millers from Ohio, with a quote saying, switching to this company was the best decision we ever made. They saved us $600 and their service is amazing. You don't know the Millers. You don't know if they're real. You don't know if their situation is anything like yours. It doesn't matter. The image of a happy, secure family triggers an emotional response. It shows you the desired outcome. It's social proof in its most potent story-driven form. They're not just selling you a policy. They're selling you membership in a club of smart, happy people who made the right decision. This is all designed to counteract the sticker shock you might be feeling. The quote is $40 higher than you expected? Well, 25 million other people are paying it, and they're giving it 4.8 stars. Maybe this price is actually a bargain for such a popular, trusted company. You're no longer comparing their price to the lowest estimate on LendingTree. You're comparing your desire to be safe and smart with the risk of choosing an unknown, less popular option. But they don't stop there. Social proof is just the opening act. Once they've made you feel like you're joining a winning team, they introduce the next layer of psychological persuasion: the authority bias. This is our innate tendency to obey, or believe, figures of authority. We trust doctors in white coats, we trust experts with fancy titles, and we trust institutions that project an image of power, stability, and expertise. Insurance companies have mastered the art of projecting this authority. You'll see it in the form of official-looking badges and seals plastered all over their website. A+ superior rating from AM. Best. J.D. Power Award for #1 in customer satisfaction. A Fortune 500 company. Most of us have no idea what AM Best is or what their rating methodology entails. We might have a vague idea of what J.D. Power does, but we don't know the specifics of the award. It doesn't matter. These logos act as symbols of external validation from a higher power. It's like a king receiving a divine blessing. It tells your brain, don't worry about the details. The experts have already done the hard work. They've certified this company as legitimate and trustworthy. They'll also lean heavily on their heritage, serving customers for over 100 years. This single phrase is incredibly powerful. It implies stability, reliability, and wisdom. It suggests that a company that has survived world wars, economic depressions, and massive societal shifts must know what it's doing. They must be good, otherwise they would have gone out of business decades ago. This taps into our respect for age and experience. It makes newer, potentially cheaper online only insurers seem flimsy and risky by comparison. Would you rather trust your financial security to a company that's been around for a century, or one that was founded 5 years ago by a tech bro in Silicon Valley? The authority bias pushes you towards the safer, more established choice, even if it costs more. This 1-2 punch is devastatingly effective. First, the social proof makes you feel emotionally secure. Everyone else is doing it, so it must be safe. Then the authority bias makes you feel logically justified. The experts have approved it, so it must be smart. You're being corralled into a corner where choosing their more expensive policy feels like the most responsible, intelligent decision you can make. You're not just buying car insurance. You're buying peace of mind, validated by both the masses and the experts. The higher price tag starts to feel less like an expense and more like an investment in quality and security. And just when you're teetering on the edge, feeling safe, feeling smart, but still maybe hesitating over that confirm purchase button, they hit you with the knockout blow. It's the oldest trick in the book because it is by far the most effective. They create a sense of urgency and scarcity. This tactic hijacks the most primitive part of your brain, the part that fears loss. The fear of missing out, or FOMO, is a far more powerful motivator than the desire for gain. We will work harder to avoid losing $100 than we will to gain $100. Insurance websites weaponize this against you with surgical precision. Suddenly, that quote you've been looking at is no longer just a number. It's a limited-time opportunity that's about to vanish forever. You'll see a countdown timer appear on the screen. Your special rate is guaranteed for the next 9 minutes and 59 seconds. A little clock ticking down second by second. That ticking isn't just counting time. It's applying direct, measurable pressure to your nervous system. It short-circuits your rational thought process. You stop thinking about coverage limits and deductibles and start thinking, I have to act now or I'll lose this deal. They'll use language designed to trigger this panic. Phrases like lock in your rate now before it expires, or due to high demand, these rates are not guaranteed. This creates a perception of scarcity. It's not just a price. It's a valuable commodity that other people are competing for, and the supply is running out. It's the same reason people rush to buy concert tickets or limited edition sneakers. The item itself becomes secondary to the fear of it being gone. You're no longer making a calm, rational financial decision. You're in a frantic race against the clock and a faceless mob of other customers who are all trying to snatch your great deal. This combination is the ultimate psychological trap. Social proof convinces you that the product is desirable. Authority convinces you that the product is high quality. And urgency convinces you that you must have it right now. Notice what's happened. You came from LendingTree, a website supposedly designed for calm, rational comparison shopping. But within minutes of landing on the insurer's actual site, you've been put through an emotional gauntlet. You've been made to feel part of a crowd, you've been made to feel deferential to authority, and now you're being made to feel a frantic sense of panic. The goal is simple, to get you to click buy before your logical brain has a chance to catch its breath. Go back to the comparison list and reconsider that cheaper option from a company that didn't use all these tricks. They have successfully shifted the entire frame of your decision from price to emotion. But the most insidious part of this whole process, the part that truly changes the game, isn't what happens on their website. It's what happens the second you give them your personal information, especially your phone number, because that's when the friendly website disappears and the real sales machine kicks into high gear. And when I say high gear, I'm not talking about a polite follow-up call. I'm talking about a full-blown multi-channel coordinated assault on your peace and quiet. It's like you've rung a dinner bell in the middle of a Shark Tank. Within seconds, maybe a minute at most, your phone will light up. It'll be a number you don't recognize. You ignore it. A few seconds later, another one. Then a text message. Then an email notification dings. And another. And another. This isn't an exaggeration. For many people, this is the literal real-world experience of hitting get my quotes on a major comparison site. You've just been converted from a curious shopper into a product. Your name, your contact information, your stated need for car insurance, all of it has been packaged up into a neat little digital file called a lead. And that lead has just been sold. Not to one person, not to one company, but to 5, 10, sometimes even more insurance agents and brokers who have paid top dollar for the privilege of calling you right now. This is the fundamental misunderstanding most people have about these sites. They think they are dealing with LendingTree or the Zebra or Gabby. But in that moment, the website's job is done. They are a matchmaker. Or more accurately, they're a lead broker. Their real customers aren't you, the consumer looking for a deal. Their real customers are the thousands of insurance agents across the country who are desperate for new clients. You are the product they are selling to those customers. Think of it like an auction. You've just walked onto the stage and announced, I need car insurance. And LendingTree, acting as the auctioneer, just sold tickets to your performance to a room full of hungry agents. And every single one of them believes they have the winning bid. The company that sold the lead gets their fee, and they are out of the picture. They've made their money. Now it's a feeding frenzy. A digital land rush where the first person to stake a claim, to get you on the phone and close the deal wins. This is why the calls come so fast and so furiously. From the agent's perspective, this is a high-stakes, high-pressure game. The lead they just bought wasn't cheap. Depending on the quality and the type of insurance, a single lead can cost an agent anywhere from $10 to $50, sometimes even more. And it's what's known in the industry as a shared lead. That means the agent knows they are not the only one who just got your number. They know that 5, maybe a dozen other competitors got the exact same information at the exact same second. Their training, their software, their entire business process is built around one single principle: speed to lead. The statistics in the sales world are brutal. The agent who makes contact within the first 5 minutes is exponentially more likely to close the sale than the agent who calls in 10. If they wait an hour, their chances plummet to almost zero. So when your phone rings 3 seconds after you hit submit, it's not a person who saw your info and thoughtfully decided to dial. It's an automated system, a dialer, that instantly connected a free agent in a call center the moment your lead hit their system. They are racing the clock, and they are racing every other agent who bought your name. They have no choice but to be aggressive. Their livelihood depends on it. And this leads to the second major point of friction: the quality of the conversation. You just spent 10 minutes meticulously filling out a form. Your car's VIN, your driving history, your address, the names and birth dates of everyone in your household. You assume the person calling has all of this information, right? That they're calling to discuss the quotes the website just showed you. Wrong. Often, the agent on the other end of the line has received little more than your name, your phone number, and the fact that you're interested in auto insurance. The data transfer from the sleek, user-friendly website to the agent's old-school customer management system is often clunky and incomplete. So what's the first thing they say? "Hi, is this John? I see you're looking for some car insurance today. To get you the most accurate quote, I just need to ask you a few questions. What's the year, make, and model of your primary vehicle?" The frustration is immense. You have to repeat everything. You have to go through the entire process you just completed, but this time over the phone with a stranger who is likely in a noisy call center, trying to get through their script as quickly as possible. You do this with the first caller. Then, 10 minutes later, when a second agent from a different company calls, you have to do it all over again. And again. And again. The seamless, modern digital experience you were promised has devolved into a series of frustrating, repetitive, and deeply impersonal phone calls. But the phone is only one front in this war for your attention. Let's talk about your email inbox. It's now a disaster zone. You'll be flooded with automated emails. "Welcome to Allstate. Your progressive quote is waiting." A note from your local farmer's agent. Most of these are generic templates, often with no specific quote information, just a plea to call them back. They're trying to establish a touchpoint to keep their brand in front of you while you're being bombarded by their competitors. And then there are the text messages. This, for many, is the real violation of privacy. A phone call can be ignored. An email can be deleted. But a text message is immediate, personal. It's a notification on your lock screen. "Hi, this is Sarah from Liberty Mutual. I have those quotes you requested online. Do you have a quick second to chat?" Feels invasive. And the problem is, you never just gave your information to Sarah from Liberty Mutual. You gave it to a comparison site who then sold it to her. The worst part is trying to make it stop. You can tell an agent on the phone, "Please put me on your do not call list," and they are legally obligated to do so. But that only stops that one agent. It doesn't stop the 5 or 10 others who also bought your lead. There is no central off switch. You have to play whack-a-mole with every single person who contacts you. Unsubscribing from the emails is the same nightmare. You aren't unsubscribing from LendingTree's list. You're on a dozen different agents' individual mailing lists now, each with its own tiny unsubscribe link at the bottom of the email. It's a digital hydra. For every one head you cut off, 2 more seem to appear. And this doesn't just last for a day or 2. Your information is now in the system. It has value. Even after a week, when the initial frenzy has died down, your lead is now considered an aged lead. It gets bundled with others and resold for a much lower price to agents who are willing to work older, less qualified prospects. That's why weeks or even months later, you might still get a random call or email from an insurance agent, following up on a quote you requested long ago, and have since forgotten about. You've become a ghost in the machine, your data living on in spreadsheets and databases, a constant source of potential revenue for an industry that never, ever forgets a phone number. So you're trapped in this digital crossfire, your phone blowing up, your inbox a war zone. All for a potentially cheaper car insurance quote. It begs the question, is there a way to get the upside, the comparison, without unleashing the sales apocalypse? Is there a secret to navigating this minefield, to get the information you want without selling your digital soul in the process? The answer is yes, but it requires a strategy. It requires you to understand the game better than they do. So let's build the playbook. Let's design the strategy that puts you back in the driver's seat. The goal is simple: extract maximum value from these powerful comparison tools while building an impenetrable fortress around your personal life. This isn't about being sneaky. It's about being smart. It's about creating a temporary, disposable digital identity purpose-built for one thing and one thing only: shopping for car insurance. First, the communication channels. Your personal email and your primary cell phone number are sacred. They are off-limits. They are not part of this operation. To even think about typing your primary email address into one of these forms is to willingly sign up for a lifetime of spam. Instead, you will create a new free email address. Go to Gmail, Outlook, whatever you prefer, and create an address specifically for this task. Something like johnsmith.carquotes2024@gmail.com. This is your new command center. It's a sterile environment where all the quotes, confirmations, and follow-ups will land, neatly separated from your actual life. Once you've secured your new policy, you can let this email address gather digital dust forever. The endless stream of "we've found new rates for you" emails will flow into a void you never have to look at again. Now for the bigger problem: the phone number. This is the one that terrifies people, and for good reason. They can't just call you. They can text you, they can use auto-dialers, and they can share that number with a dozen different agents. Giving them a fake number like 555-1234 won't work. The system will reject it, and you won't get your quotes. They need a real working number to validate you as a lead. So we'll give them one, just not yours. The solution is a beautiful free tool from Google called Google Voice. If you don't have it, get it. It takes about 5 minutes to set up. It gives you a brand new, fully functional phone number that you can link to your cell phone or just use on your computer. This number is your digital shield. It's your firewall. When you fill out the forms on LendingTree or any other site, you will use your Google Voice number. Here's why this is a game changer. The calls from agents will still come, but they won't be ringing your actual phone line. They'll come through the Google Voice app. You can see who's calling. You can screen every single call. You can set up a custom voicemail that says something like, "You've reached my insurance quote line. Please leave a detailed message with the quote information, and I will review it later." Better yet, you can just put the app on Do Not Disturb and let every single call go straight to voicemail. The power dynamic has now completely flipped. They are no longer interrupting your dinner. They are no longer buzzing your pocket during a meeting. They are leaving messages for you to review on your schedule. You have contained the chaos. And just like the burner email, once you're done, you can silence that number forever. Okay, you forged your digital shield. You have your burner email and your Google Voice number. Now it's time to go into battle. When you're on the comparison site, you're going to be a ghost with a paper trail. You use your burner contact info every single time. But, and this is critical, everything else must be deadly accurate. Your name, your date of birth, your address, your vehicle's VIN number. Do not lie about these things. Why? Because lying here only wastes your own time. The insurance companies use this core information to pull your official records. They pull your motor vehicle report to see your driving history, any tickets, any accidents. In most states, they also do a soft pull on your credit to generate an insurance score. If you say you have a perfect record but you have 2 speeding tickets, the initial quote you see on the screen is pure fantasy. The real quote, the one that comes later, will be dramatically different. You need to give them the real data so they can give you a real, committable quote. Think of it this way: you're giving them the information they need to do their job, but you are maintaining absolute control over how they are allowed to communicate the results of that job back to you. They get the data they need, you get the privacy you deserve. Once you hit that Get Quotes button, the floodgates will open. But you're ready. You've built an ark. The emails will start pouring into your burner inbox. Perfect. Let them. Now you have a single dedicated place to review every offer. You can create folders, flag the best ones, and compare them side by side without it getting mixed up with your Amazon receipts and work emails. The phone calls will start hitting your Google Voice number. Let them go to voicemail. An hour later, you can sit down with a cup of coffee and listen to the messages. An agent from Progressive left a quote that's $100 cheaper? Great. You see their number in the call log. You can call them back when you are ready. You are no longer the hunted. You are the hunter. You initiate the conversation. So, what's the most effective way to deploy this strategy? Do you do one site at a time over a week? Or do you go all in at once? There are 2 schools of thought here: the slow burn and the blitz. The slow burn is doing 1 comparison site per day. Monday you do LendingTree. Tuesday you do the Zebra. Wednesday you do another. The advantage is that it's less overwhelming. You deal with one small wave of emails and calls at a time. The disadvantage is that it drags out a process that nobody enjoys. I am a firm believer in the Blitz. Set aside 1 hour. Get your information ready, your driver's license, your VINs, your burner contact info. And then, in that single hour, you fill out the forms for 2 or 3 of the top comparison sites. Yes, the next 24 hours will be an intense barrage of communication, but it's all hitting your contained, firewalled system. The beauty of the Blitz is that it concentrates the entire painful part of the process into one short period. You get all the data you're going to get, all at once. You can then spend the next day or 2 analyzing your complete set of offers. And don't worry about multiple sites pulling your information in a short window. Insurance inquiries are considered soft pulls on your credit, not hard pulls like a car loan or mortgage application. Soft pulls do not impact your credit score, so hitting multiple sites in one day won't hurt you. The Blitz gets it all done, gets it done fast, and lets you move on with your life. By following this playbook, you fundamentally altered the transaction. You've used the system to your advantage. You've harvested the immense power of these aggregators to make dozens of companies compete for your business, all while protecting your sanity and your privacy. You now have a folder full of quotes and a log of voicemails from agents eager to talk. But this is where the real work begins. You have the numbers, but what do they actually mean? Is the absolute cheapest quote always the best choice? Spoiler alert, it almost never is. Hidden inside those quotes are dozens of variables, coverage limits, and deductibles that can mean the difference between total security and financial ruin. How do you decipher that jargon? How do you compare an offer from Geico with a bodily injury limit of 50/100 against an offer from a smaller company with a limit of 25/50, even if it's cheaper? What are you really buying, and how much of it do you actually need? That is the final, most crucial piece of the puzzle. Let's break that down, because those numbers you see on a comparison site, 25/50/25, 50/100/50, 100/300/100, aren't just random numbers. They are the financial armor you are buying. Understanding them is the difference between being protected and being financially ruined. First, let's talk about liability coverage. This is the one part of your insurance that is legally required in almost every state. But here's the secret. It has absolutely nothing to do with you, your car, or your injuries. Liability coverage is for the other person. It's the money your insurance company will pay out to the people you hit when an accident is your fault. It's the, "I'm sorry I wrecked your new Lexus and sent you to the hospital" fund. The numbers are broken into 3 parts. If you see 50/100/50, here's what it means. The first number, 50, stands for $50,000. That is the maximum amount your insurance will pay for any single person's bodily injuries in an accident you cause. The second number, 100, is $100,000. That's the maximum total amount they'll pay for all bodily injuries combined in a single accident. So if you hit a car with 3 people in it, your insurance will pay out a maximum of $100,000 for their medical bills, no matter how badly they're hurt, and no single one of them can get more than $50,000. The third number, 50, is for property damage. That's the maximum they'll pay to repair or replace the other person's car, or their mailbox, or the storefront you just drove through. $50,000. Now pause and think about that. The state minimum in many places is 25/50/25. Do you know how much a new car costs today? The average is well over $45,000. A new pickup truck or a nice SUV, you're looking at $60,000, $70,000, $80,000. If you have a $25,000 property damage limit and you total someone's brand new Ford F-150, you are personally on the hook for the other $40,000 or $50,000. And that's before we even talk about medical bills. A single helicopter ride to a hospital can be over $50,000. A multi-day hospital stay with surgery can easily break 6 figures. If your bodily injury limit is $25,000 or $50,000, that money is gone in an instant. And after the insurance money runs out, who do they come after for the rest? They come after you, your savings, your investments. They can garnish your future wages. They can put a lien on your house. Choosing the state minimum liability is like showing up to a gunfight with a water pistol. The comparison sites make it incredibly easy to just click the cheapest option, which is always the state minimum. This is the single biggest trap. The difference in premium between a dangerously low 25/50/25 policy And a much safer 100/300/100 policy might be $20 or $30 a month. It is the best money you will ever spend. Your guiding principle for liability should be this. You need enough coverage to protect your net worth. If you own a home, have a 401k, and some savings, you are a target for a lawsuit. Your liability limits should, at a bare minimum, exceed your total net worth. Next, you have collision and comprehensive. These two are about protecting your car. Collision covers damage to your vehicle from, well, a collision, hitting another car, a pole, a guardrail. Comprehensive covers almost everything else. Theft, vandalism, a tree branch falling on it, hail damage, hitting a deer. This is where you have to be honest about your car's value. If you're driving a 15-year-old Honda Civic worth $2,000, paying an extra $40 a month for a policy with a $1,000 deductible for collision might not make sense. You could pay for half the car's value in premiums in a single year. You might be better off self-insuring, meaning you just save that money and are prepared to pay for repairs or a new beater yourself. But if you have a loan on your car, the lender will almost certainly require you to have both. And if you have a $50,000 SUV, going without them is just financial insanity. Then we get to the really important ones that people often ignore: uninsured and underinsured motorist coverage. Let this sink in. The Insurance Research Council estimates that 1 in 8 drivers on the road has no insurance at all. That's almost 13% of people. In some states, it's over 20%. If one of them hits you and puts you in the hospital, their non-existent insurance pays you exactly zero. This is where uninsured motorist coverage saves you. It acts like the other driver's liability insurance, paying for your medical bills and lost wages. Underinsured is similar. It kicks in when the at-fault driver has insurance, but their pathetic state minimum policy runs out before your bills are paid. Do not skip this coverage. It is shockingly inexpensive, and it protects you from the irresponsibility of others. So how do you put this all together when you're staring at a LendingTree results page with 10 different quotes? You have to transform from a passive price shopper into an active risk manager. First, ignore the default cheapest quote they show you. Go into the coverage settings. Immediately raise your liability limits to at least 100/300/100. If you have significant assets like a paid-off house or a hefty retirement account, you should be looking at 250/500/100 or even considering an umbrella policy, which is a separate policy that adds $1 million or more of liability coverage on top of your auto and home insurance. Second, look at your uninsured/underinsured motorist coverage. A good rule of thumb is to match it to your own liability limits. If you're protecting others with a $100,000 policy, you should demand the same level of protection for yourself. Third, play with the collision and comprehensive deductibles. A deductible is what you pay out of pocket before the insurance kicks in. Raising your deductible from $500 to $1,000 can significantly lower your premium. Ask yourself, can I comfortably write a check for $1,000 tomorrow if I need to? If the answer is yes, you could save hundreds of dollars a year by taking on a little more of the initial risk yourself. Now rerun the comparison. The prices will change, but you are now conducting a true apples-to-apples comparison of meaningful protective policies. You're no longer comparing a steak dinner from Geico to a bag of chips from some unknown company. You're comparing steak to steak. This is the ultimate power of a comparison site. It's not just a vending machine for cheap insurance. It's a laboratory. It allows you to model different scenarios. What happens to my rate if I choose a higher deductible? How much more does a truly protective liability limit actually cost? You can get these answers in minutes, without spending hours on the phone with 10 different agents. So what is the final verdict on sites like LendingTree, The Zebra, and Insurify? They are powerful, but they are also dangerous. They are a phenomenal tool for the beginning of your insurance journey, but a terrible place to end it. Use them as a discovery engine. Use them to get a quick pulse on the market and find out which 2 or 3 companies are offering the most competitive rates for the robust coverage you just built. You might discover a smaller, regional company like Erie or Auto Owners that has incredible rates and fantastic customer service, a company you never would have found otherwise. But once you have those top 2 or 3 names, your work on the comparison site is done. Close the tab. Your next step is to go directly to those companies' websites, or even better, call a local independent agent who represents them. Why? Because the comparison site only gives you a blunt estimate. A direct quote will be more accurate. You can discuss specific discounts they didn't ask about, like for being a good student, having an anti-theft device, or bundling with renter's insurance. You can ask questions and get a feel for their customer service. You are taking the data from the machine and applying human intelligence to it. In the end, car insurance is not a commodity like a gallon of milk. It's a complex, personalized promise. A promise that if the worst day of your life happens, someone will be there to help you put the pieces back together. A comparison site can help you find who is making that promise for the best price, but it can't tell you the quality of that promise. That requires you to do the final bit of homework. By using the site to find the contenders, and then using your own knowledge to vet them and build the right policy, you get the best of both worlds. The speed and breadth of technology, and the wisdom and security of a well-informed decision. The cheapest policy is almost always the one with giant, gaping holes in its coverage. Cheap for a reason. The most expensive policy you will ever own is the cheap one that fails to protect you when you need it most. Don't just shop for a price. Shop for protection. Shop for peace of mind. Choose wisely.